the debt you're taking on is going to be higher than the cap rate, it's not really making a lot of sense. You know what I mean? Mm-hmm. You with me?
No,
on that?
I totally get you, and I've heard a lot of people make that comparison. Like, if your debt rate's higher, you're going to want a higher cap rate. Yeah, which makes total sense. You just need a higher pre-debt financing rate of return to finance or to service that debt.
And the only way I would go out of line on that is a true value add play.
Welcome back to REI Hot Seat. Andrew Hines with David Hulshof here, and we have yet another deal to look at. We're deal rich lately, so let's.
The market is getting better for opportunities. There you go.
Yeah. So this is another on market.
Yeah, we were trying to segment just a few on market deals because again, we keep hearing there's no good deals on market. Again, we're still doing about the same volume off right now, so it's probably about 80%. But there's more quality inventory. I think you just have to create it a little bit. So some of what you're seeing is when you run the numbers right out of the gates, it's perhaps not as exciting. But if you dive a little deeper and get it from a little bit better of a purchase price or some good structure, they start to make sense.
The key is knowing, sort of the template structure you want. Can you make it fit into your mold, and then you just start pulling on the levers? What can we do?
Yeah. And that's why again, it's about what are you trying to accomplish? Like, what's your goal? So this particular deal is similar to what we've been doing a lot of, which is the hybrid. We need to think of a better name, by the way. Hybrid deals are not good. It's like you can go to CMHC. It's got some lift.
Yeah, I gotcha.
So maybe that's a goal for maybe somebody can comment.
You don't like the name? Okay.
I think we could do better, and maybe the audience can.
So there's some lift. A deal. I like the idea of a deal where there's some down the road win that you could have that you don't need to do. You could come into it, just set it and forget it, or you could also work to get it to yield better.
This is the structured properly. These are the ones that are really hard to screw up, right? Because you're buying it, you're cash flowing positive. Well, assuming we get it for a good price, good quality debt, and still a little bit of area to improve on.
Yeah. Okay. So tell me about this one.
So not our listing. It is on MLS. It's it's a purpose-built 9-unit. All of them are one beds. It's in Hamilton, kind of central Hamilton area.
How old do you think, approx?
I'm going to say 40s, 50s, but I'm pretty bad at guessing, to be honest.
Okay, 40s, 50s.
So 122 Victoria Ave, Hamilton. List price is $189. That puts it at $210 a door. With our underwriting, that's about a 6.7 cap. So a little bit low for what I'd like to see.
6.7?
Sorry, 4.6.
I was about to say 6.
I dyslexic. Yeah, 6.7, and I don't like it.
That's low?
Yeah. I wondered. You look perplexed. Yeah, sorry, 4.67.
Yeah, where do you like to see them?
On a deal like this, in the 5s for sure. You're probably not in Hamilton going to get in the 6s, but sort of depends.
So you just want to be somewhere in the 5s.
In the 5s, like on a hybrid. If the debt you're taking on is going to be higher than the cap rate, it's not really making a lot of sense. You know what I mean? Mm-hmm. You with me?
No, I totally get you, and I've heard a lot of people make that comparison. Like, if your debt rate's higher, you're going to want a higher cap rate. Yeah, which makes total sense. You just need a higher pre-debt financing rate of return to finance or to service that debt.
And the only way I would go out of line on that is a true value add play. Yeah. Right. So we've got a vacant building in London, for example, an 8-unit. Your debt is going to be much more expensive than the cap rate. First of all, it's vacant, right? And second, it's going to be some creative borrowing. So,
and those used to be all what everybody would do. The value add plays. It's still less common than it was 3 years ago.
It's crazy how that shifted. Like,
well, the debt price is really what did it, right?
Yeah, and then the fear and the sentiment. Like some people lost their shirts because they overextended themselves, right? But we're seeing a resurgence back to an interest to those style of deals. Yeah.
Had to come back at some point. Okay, let's work through how you'd make this work. So I'm assuming if you're bringing in a client, you're probably not offering at that cap rate.
No. So the idea for us, just kind of like the last deal we talked about, was there is some lift, but we're going to ship this off, send it to CMHC, get good quality debt on it, and then start to add value once we're safe and secure. So where I'll start is kind of in the other sheet, which I usually end with this. So if we bought this deal at list, $1.89 million, 80% loan to value, CMHC won't fund it. And if you go over to this box here,
they're not going to do 80%.
No.
So they'd shave you back until it hit 1.1, right?
Yeah, in this deal 1.2 because
1.2
standard.
Okay, yeah.
So let's say I'm going to guess it's I first try. Sorry, I didn't practice that. So 70%.
70% works. Okay.
So 70 is not bad. It's just not compelling enough in comparison to other deals I've put together.
Well, then you're going to have to look at your cash on cash return, which any investor is going to be thinking like, how much am I getting for how much I'm putting in? Cash on cash is one part, and then of course overall return.
Yep.
You're coming in with that much when the other people are coming in with 5% down on deals. It really does change what your return
100%.
is significantly.
Yeah, so we just ran cash on cash. It's 2.25.
Right.
We can't have that.
So it is sort of premium area being Hamilton, but probably going to have to be a little bit of a flex on that in terms of an offer price.
And if we go to financials, like another metrics would be what it's worth. Let's say that their list price is accurate and what we feel it'll be worth when you fully turned. If best case stabilized value, we're at 2.25 million. That's a 5.5 cap, right? So we're off. Something's off because you would expect a better cash on cash.
So you're stabilized. The only difference really is just increasing those monthly rents on the low ones.
You got it.
That's it.
And this is where with clients we'll have these conversations because the reality is this one at 1600.
You're not going to adjust that one.
No chance. Neither are you going to do it for this one, and you're probably not going to. So
you're going to focus on the really low ones. Yeah.
Yeah, and a lot of times people aren't leaving. That's fine. We give them the option, cash for keys, but you got to build that in, and that's a whole different sheet, different discussion. But where I look at this areas for win, obviously, if we're offering, the price has to come down. It's just a little bit overpriced, and not knocking the agent. I know him; he's a good agent. I would probably list somewhere here too. A little bit more aggressive, but people are seeing an offer price. Nobody's giving list. Nobody's buying at list price.
Yeah, so it's almost like price it a little higher to leave room to negotiate.
Yeah, exactly.
Yeah. So maybe that's what's happening here.
That's what I'm thinking. So if we go to 1.6 million, let's see, where do we get to? There we go. That's probably bang on. I'd like to see 85. We're pretty close. So that's actually not a bad handle.
Your cash on cash is up over 4. That helps.
You're in for 340,000. You're 4.5% interest, 40-year M. So this, now, will they accept it? I don't know. But to me, 1.6, you're 177 a door. They're all one bed. So we're kind of jiving. Like they'll probably obviously want more, but starts to make sense to me right around here.
Yeah. What are the value add plays, do you think, on this building?
That's a great question. So everything's metered right now.
So all the utilities, you're not going to be saving on any of that?
Yeah, well, it's interesting. Everything's metered. Hydro's $100, so that makes sense. They have 11 parking spots, so this is a big win here.
None of them are being charged?
There's no dollars for parking here.
Okay. Do you think they're all built into the leases?
And this is the value of plug for us, of working with people that know what they're doing. We have to review the leases, make sure they're, because if it's attached on the lease, assuming they're not, big opportunity for lift there.
Yeah. Question for you. Do you have to charge HST when you rent at a parking spot?
I don't know.
Generally, people probably don't, right?
No.
Because it's kind of attached to residential.
That's a great question.
Yeah. I would think that technically probably, but almost nobody does. Not advice, just my observation.
Yeah. You got my hamster spinning now because I'm not charging HST on it.
Yeah, who knows?
For another day, but
yeah. One of those technicalities. I mean, for the longest time, because now it's become like this thing. People are saying, "Oh, did you hear like the new Airbnb thing? Like now, if you use your house for Airbnb, it's like you now have to charge HST on the house when you sell it." That was always the case. They just weren't really enforcing it. I guess now it's become more of a talk, and it's now more likely to be enforced.
Right.
Yeah, so I think this might be a similar thing where it's probably just very common. And because it's so small, it's not being touched. But who knows? I could be wrong.
Yeah. So let's do the impact of it. So let's just say 50. So what we'll do is $50 a spot. Okay. And we'll just see how that impacts it. So now we're at a 1.28 debt cover.
Yeah.
And cash flow or cash on cash is almost 6%.
Yeah, so that one little change of just adding in parking spots as a billable makes a massive difference.
Now you can take it to 85. And presumably here, and I hope this doesn't get used against me by the agent here, but looking like perhaps we could come up on price a little bit. So let's have a look. Yeah. So where I start to like it now, this is the challenge, right? This is the art, the science of the negotiation is I'm not going to pay for something that they're not earning income on.
Yeah, you're just saying what you could do.
Right.
And for anyone not completely following, Dave's pulling the levers. Like, how can if I can increase revenue, top line, now maybe I can pay a little bit more. Now, sort of making the deal work by pulling the different levers that are
Beautiful summary.
at our advantage.
Yeah, very well said. So that's exactly what I'm doing is saying, hey, will they take a 177 a unit when some of them are rent out? That's a pretty compelling deal. So they're probably going to want us to come up. So I think we're right in range. 1.6, 165. You're 177 to 183 a unit. You're kind of mid 5 caps with some lift. And I would also want the time to go to CMHC because if they don't give us that,
you got to get the time for that.
Then you got to close in a bridge, and it's going to be more expensive.
Yeah, that adds up a bunch of costs to your deal, which when you're already tight, you can't. Which I think they'd be more inclined, obviously knowing it's a little bit premium priced, to maybe say, okay, yeah, we'll give you the time.
Yeah, exactly. Like this is where the deal structure makes sense, but then you start to look at this deal 165. It's good. I like it right around where we have it. Makes a lot of sense. There's a clean phase one. Things are metered. Tenant's profile is supposed to be pretty strong. So
like in terms of a price per door, you're saying this one would be a little bit lower because they're all 1 beds, not 2s.
Yeah, I always say like price per door is like doing surgery with a butter knife. All right.
Yeah, you really got to look at what they can earn.
Yeah, it's really just it's just a metrics of if you send me a deal that's a value add and it's $300 a door in Hamilton,
then you're just going to not bother.
We're not going to run numbers, right? But right around that $200 a unit on this is where we start to pay attention.
Gotcha. Okay. Any other thoughts here on this one? Like things you think we should share? Or we more or less covered it?
I think we got it all.
No opportunity for storage here. I guess there's no extra.
I haven't been through it, so I'm not sure. But you know me, I'm a sucker for storage.
Oh yeah, I'm wondering if it would never really make sense to build it, but I'm wondering if you can put like flat packs. Probably not in Hamilton.
No.
Yeah, you won't get away with that.
Tight there, yeah.
Yeah, that's too bad. But okay. All right, guys, if you've made it this far, please show the video some love, show the channel some love. If you have questions you wish that I would ask on the show today when we're analyzing deals, leave that in a comment.
Yeah.
We'll make sure that we get those answers for you.
And a better name. We need a better name for these deals.
Than the hybrids.
For me.
It doesn't offend me, but okay.
Wow, I'm too tight.
Yeah, and then the other thing is, of course, the REI Hot Seat Insiders list. Make sure that you're on that list. The link will be below the video, or if you're in the podcast platforms, it's in the show notes. And that just gets you on the list. It gets you access to off-market deals with these guys. It also gets you on the phone call with Dave or a member of the team to kind of go over what your goals are and how they might be able to help. So
amazing.
Alrighty. Thanks a lot. We'll see you again next week.
Thanks, guys.